This video is about how the commodity markets work. And having spent 15 years in the commodity world, 7 of which I worked for an energy and agribusiness firm focused on numerous commodities and studying commodities daily, I can tell you the commodity markets don't work anything like is commonly said. The common view is that commodity markets are based on supply and demand, and that it is supply and demand moving those markets. Well, actually, that is a true statement. It's always supply and demand moving any market. That's the only thing that moves a market. But in the commodities world, um, what the commodities world calls demand is not in any way actually demand. So I'll give you the answer up front, and then I will explain what I'm talking about. So the main thing that moves commodity markets is money. That is what is actual true demand. So let me explain. So, in the commodities world, supply and demand are ever present. Supply and demand balance sheets are always presented, showing you the supply and demand. The problem with these balance sheets is not on the supply side because supply is supply. It's number of units produced, it's quantity. The problem with the supply-demand balance sheets is that they also put demand in the form of quantities. So it's quantities versus quantities. So for example, not for example, for every commodity, it is the number of units produced and supplied for supply, and it's the number of units used or consumed and or stored, but storage is minor. Let's focus on usage as demand. So note that both of those magnitudes are in quantity, number of units. So when you see a supply-demand balance sheet, those numbers, the supply number relative to the demand number, are generally right in line with each other. There's some separation on a chart for usage, which is why people think usage is a big thing. Sorry, not usage. I meant to say stocks or storage. They think that the amount stored, i.e. not used immediately, is significant. It's not. It's just temporary, held up, locked up demand. And it's usually pretty temporary, especially for food-oriented commodities like corn, wheat, soybeans, etc. But focusing on supply and demand, demand or usage is just really the flip side of supply. However much is produced in a given year will generally be used that year or soon after, and that's it. Supply equals demand. What's produced is consumed. What's supplied is taken and used with a delay, but okay, big deal. So that's not a smart way to look at supply and demand, both in the same magnitude. So do you see anything funny about that magnitude of quantity? We're measuring supply in terms of quantity, demand in terms of quantity, but strangely, commodities are priced in dollars. Where do the dollars come in? How do you get a dollar number out of a physical quantity of supply and a physical quantity of demand? Who says that a certain supply and demand equal a certain dollar amount? They don't. In work I've published, I've shown where supply and demand for different years are about the same. I forget what years they were, something like, I just take as an example, 2003 and 2011 had about the same supply and demand for a commodity, but the price was twice as high in one year. So to be very specific, let's say 2003 had a quantity produced of 100, a quantity used, i.e. demand, of 98. Okay, 198. Well, 10 years later, the numbers were comparable. Let's call it 101 and 99. Basically the same quantity of supply, same quantity of demand, but the price of the commodity in question would be twice as high 10 years later. So how do commodity economists explain that virtually the same supply and demand result in a price that is twice as high or half as much two different points in time? They don't. They can't. There is no explanation because that makes no sense. That is not the way to look at things. Let me explain what demand is. In any market, anywhere in the world, demand is always spending. It's not the number of units. It's not how much somebody wants something. It is how much money is handed over and spent. There's never any other explanation for demand. For example, in the stock market, people think that it is a growing economy that makes the stock market go higher. It's not. It's more money being spent. It's money flowing into the stock market. That's demand. Consumer prices. We increase the supply of consumer goods every year, most years, in most developed countries, but the prices always seem to go higher. Why is that? Because the amount of demand, i.e. money spent, increases at a faster rate than the amount of supply or production. And that's because the government, with the central bank, prints money at a faster rate than we can produce goods. They do it on purpose. They want a positive rate of inflation. So similarly, in the commodity market, prices go up because of an increase in demand or money. They go up because of an increase in money spent. So the right way to look at the supply-demand balance sheet is the amount of supply, as is currently done, but instead of the amount of usage or consumption, it should be the amount of the total quantity of money spent. And that gives you exactly, it explains perfectly the price. So for example, in 2003, if corn was at, I don't know what it was, $2 per bushel, but in 2011, it was twice as high, while the supply was the same. Okay, well, look at the numerator of amount spent. It would have doubled. And basically it did, by the way, between 2003 and 2011. And so that's why corn prices were about twice as high. The amount of money spent in that market doubled. So your numerator should be money spent. Your denominator should be quantity supplied. That gives you a price, a dollar amount, per quantity, per bushel in this case. So in the commodity markets, it's a lot different than other markets. In the real economy, consumer prices increase because the government is printing money. More specifically, the government is giving the banks the ability to print money. The banks make loans, and money is created when it's lent out. So people take the new money, they buy houses, cars, goods, that drives up the prices of houses, cars, and other goods. So that's where that inflation comes from. What about the stock market? Well, similarly, money that's printed by the central bank and the individual banks, that money flows directly into the stock market. And by the way, at a disproportionate rate. That's why the stock market goes higher faster than the real economy. That's why PE ratios continually increase. Money is flowing into the stock market at a faster rate than it's flowing into the real economy. So each different kind of market has a different rate of asset price inflation based on the different speed at which, or the different quantity which flows into that market in a certain amount of time. Now back to commodities. Commodities get the least of that inflation. And most of the money that flows into commodities doesn't flow in directly from the central bank. It flows in indirectly from the central bank. That's by way of mostly money managers and hedge funds and the like, diverting money from the stock and bond markets and other markets, venture capital and so forth. All of those markets are much larger than the commodity markets. The equity markets, I forget where it is now, but the equity markets are somewhere near 60 trillion, or is it the stock and bond market together? I forget which, but tens and tens of billions of dollars. The two together might be more than 100 trillion now. The commodity markets are only a couple of trillion, maybe it's 4 trillion by now. I don't know the exact number at this point, but it's very small. The commodity markets are very small relative to the stock and bond and other markets. So you get a little money coming into the commodity markets from general price inflation, like from farmers hedging their crop and so forth. Okay. But most of it comes from investment managers. It comes from Wall Street, coming in from the stock, bond, and other markets as an asset allocation shift. That money comes into the commodity markets periodically in waves. It comes and it goes. So in the 80s, or sorry, in the 90s and early 2000s, you had virtually no money from Wall Street. But starting in 2004, 5, 6, money came pouring into the commodity markets from those other markets. How do we know it's the other markets? Well, if you look at CFTC data, the CFTC logs the purchaser. It logs who's holding the contracts, and it classifies them according to the type of purchaser they are. And one of the areas is, as I call it, Wall Street. I forget what CFTC calls it now, a couple of different categories. I think managed money is the main one related to Wall Street. So you can get the data and chart it, as I have, and you can see, for example, in the early 2000s, Wall Street money was a minority of money spent in the different commodity markets. But by 2008, it was the majority of money spent in those markets. So that tells you that it was mostly Wall Street money coming in to the commodity markets, which pushed up the price of commodities. And you can see it commodity by commodity. You can see the share of Wall Street spending increasing dramatically and becoming the dominant. You can also see in some areas during that time, such as cotton, where it didn't come in very much, and therefore it didn't push up the price very much. Just because Wall Street money comes in doesn't mean it goes to each and every single commodity. There are favorites. So that is the main source of commodity inflation or rising prices in the commodity markets. And again, that money, that inflation is less than takes place certainly in the stock market and really than takes place in the real economy. Commodity prices over time do not rise as much as consumer prices, which is why farmers, by the way, have such a tough time. They're always losing because their prices are rising less than their selling prices of their commodities are rising less than the cost of their inputs. That's why we often have to, not often, we regularly give money to farmers and bail out farmers. Um, so um, Otherwise, moving on, commodities tend to have these waves of money that comes in, pushing them to higher price levels, but periodically. So that's why commodities tend to stay rather flatlined as a group for decades at a time, maybe a decade or two. And then they take off and move to a higher plateau where they then trade sideways more or less for another decade or so. And but within those plateaus, when they're not moving to higher levels, they tend to oscillate in a range. So people always talk of commodities being very volatile, and they certainly are. As a group, they're not. They just kind of sit there and do nothing for a majority of years, or the index kind of meanders. But individual commodities are oscillating wildly. They have supply and demand information that comes along. I would say, really, supply, going back to the beginning of this discussion. The big changes are not the demand. People are not even watching the monetary demand. They're basically watching supply. So you have supply changes that cause that commodity's price to react and react strongly, and that's legitimate. If you have a shortage of a commodity, the price should go up. If you have an increase in the supply of a commodity, then the price should go down, and it does. But here's the kicker. If you didn't have the money coming in from Wall Street, the price supply, the change in the price of that commodity, given that supply news, would be marginal. I mean, for example, if you have a supply reduction of 15%, you would get an increase in prices of 17, 18%, just mathematically, and vice versa. So you would get those kinds of movements, which, by the way, you used to in the old days when, like during the Bretton Woods era, and commodities were, currencies were tied together and they were stable. You didn't have these massive money flows. And commodity markets were rather flat. But now, with all the money flows, they're very volatile. But anyway, so each commodity um, will react to the fundamental supply information. But here's the kicker. When even when hedge funds are not there, what happens is you still always have hedge funds in the market. Let me back up quickly. You always have hedge funds in the market, but there are periods when all the funds come in hordes, when there are 10 times as many. And so that's the different kind of regime I'm referring to when hedge funds are in the commodity markets in general, even though you always have some there. So you have fundamental news that comes across and the price goes up, let's say, but then the hedge funds come in and jump on that trend, and individual traders, and they push that price further. But during periods like the last 5 years, where hedge funds have been heavily into the commodity market, you'll have that price exacerbated 2, 3, 4-fold. So let me give you a few quick examples. You had cocoa in the last few years have a supply decrease. Most of the production of cocoa is in West Africa, and there have been droughts and so forth. And the supply in West Africa has declined, if I recall, about 35%. Globally, that supply reduction is only about 13.5%, which would only push the price up 15, 16% tops. But let's just assume, let's be conservative and say it was the same, the global supply change was the same as it was in West Africa, where the majority of cocoa is produced. That supply reduction of 35% mathematically would justify a price increase of about 40%. That's how much the price of cocoa should go up. How much did it go up in the last couple of years? 400%, 10 times what it should have. The difference between the 40% that it would have gone up based on normal supply and demand fundamental news and 400% that it did go up is hedge funds and other funds and other individual investors. But it's, let's call it speculators jumping on that trend, chasing the trend and pushing prices up higher and higher and higher. So that is how a 35% reduction in cocoa supply went up 400%. Nothing to do with the real fundamentals. It had to do with money. Those hedge funds brought money, and to buy the commodity, they've got to spend money. When they spend money, that drives the price higher. If you insert money into a market, the price necessarily goes higher. You cannot insert money into a market and not have it go higher. It absolutely has to go higher, and that is what happened. Another example is orange juice. Orange juice has had about a 15.1% reduction in supply over the last couple of years due to disease mostly, or globally, and some other supply problems. But again, 15%. What did the price do? It went up dramatically. I forget what that number is, but it was again 2, 3, 4, maybe 500%. It was ridiculous. And now the disease status has improved a little, not a lot, but a little, and the price collapsed and it plummeted right back to where it started within a matter of months, like 6 months. That is not fundamental news. I mean, that's not a reaction from fundamental news. That is a bunch of hedge funds with a lot of money jumping on, riding the ride based on fundamental news, exacerbating the move, and then jumping off and sending the commodity right back to where it started. A couple of final points I would like to comment on, since this is a talk about the commodity markets as a whole. It's not as prevalent now, but 20 and 15 years ago, a common argument was that it was China driving commodity prices. It's hard to overstate how absurd that argument was. That argument was given because people in the commodity world had no idea what was driving commodity prices. They're looking at those supply and demand charts I told you about at first, which are based in quantities, not keeping up with the amount of money spent and not realizing that all of these commodity prices were rising because of all the money that had flowed into that market. Just not even aware of it, not thinking about money. Money is not a way that people in the commodities world think. Never, ever, ever. And maybe not never, ever, but in general, they don't mention money, I guarantee you. It's all supply and demand and units, and it's these explanations like China. When they don't have an explanation for something, they basically make them up. And China was one that they made up. They look around in the world and they see China, as they say, consuming all of these commodities because China is growing so dramatically. They're consuming a lot of steel, iron ore, aluminum, you name it. Well, here's the problem with the China argument. China doesn't buy the commodities that were going up in price, i.e., the Western commodities traded on Western exchanges, mainly in the United States. China doesn't buy those commodities. Yeah, it buys a few of some of the commodities, like 40% of soybeans, but that doesn't explain soybean prices going up, especially when soybean prices go up about the same as corn, wheat, oats, soybean meal, etc., that China doesn't buy. Well, they might buy soybean meal, but you get the point. All the grains tend to move together. Soybeans do what the other grains do. China buys soybeans, but none of the other grains. But as a rule, China doesn't buy Western commodities. It's not coming to these markets and taking these commodities and inserting money in our markets. No, China is consuming so many commodities and it's such a global, it has such a high share of global consumption because it's consuming its own commodities. China is the biggest producer of commodities in the world in general. It produces most of the commodities in most areas, like iron ore, um, cement. It's the major producer. And so it's the major producer of most commodities, or it's a lead producer of most. And so China's consuming so many commodities because it's producing so many. It's consuming its own production. It's not coming and taking our production. So if it's not buying our commodities and not spending money, i.e., it's not expressing any demand in our markets, then it can't be responsible for affecting our commodity prices. But that's what people have claimed for years and years. I argued and debated this with people in the industry. For years, no one ever believed a word I said. But I just researched it. It's a diminishing argument. Fewer people believe it now, even though many still make the argument. And it's a minority argument now. So slowly but surely, people have quit making this argument or lessened it. And they were never right the whole time. Another similar argument that used to be made, I'm not sure if it still is the world is hungry. And that argument goes like this. Well, the world is growing, the population's growing, and many people are hungry in the world, and they need food. So there's a demand for food. So that's why commodity prices are rising. All right, well, first, that doesn't explain why non-food commodity prices like crude oil and steel are rising at the same rate, but never mind. Um, Secondly, people have always been hungry. People are always hungry in the developing world. They don't have capitalism, they don't have free markets. Many of them are starving. But by the way, they're starving less than ever. Poverty and global hunger have diminished in the last 20 years. They haven't increased, they've diminished. So prices should not be increasing faster than they used to. Um, Thirdly, okay, well, if the world is hungry, we'll increase the supply as we always do, and that lowers the price. And fourthly, if it can't be demand because the people are, if they're starving, they don't have any money, they don't have a demand, so they're not going to drive prices up with the demand. And if you think they are, again, what about the supply? They'll cause the supply to increase. In short, supply and demand increase basically at a linear rate of food production worldwide. It has for years, and fewer and fewer and fewer people are hungry over time. So we're not prices aren't rising because people need stuff. They always need stuff. We're always producing stuff, and we're filling those needs more than ever. That's not why prices were rising. They were rising because a bunch of money flowed in, because the government is printing a bunch of money, and participants from other investment areas redirected and channeled money into the commodity markets. So that is the long and short of the commodity markets and how they work. In short, just a bunch of money sloshing around, driving prices higher and lower. There is some fundamental information moving prices a little, but most of the price movements come from the tons of money sloshing around. Okay, hope you enjoyed it. That's it. Thank you.